Absolutely. So we saw the VIX spike to an intraday high of 66, a level that was only exceeded during the global financial crisis and COVID. And we would argue that the current fundamental backdrop is quite different from those prior two occasions. The global financial system is not melting down, and we're not facing a global pandemic. So it does seem that some technical factors pushed the VIX meaningfully higher, and they were exacerbated by some macro concerns. So when we look at the synchronized decline that we saw across equity prices, bond yields, and commodities, they do seem to suggest that macro fears played a role, as well as the technical factors, the systematic selling, the unwinding of the yen carry trade, and so on. So it's just difficult to know whether the worst is over, as many of our clients are asking us. So volatility could remain elevated for quite a while. We have some key data points this week. You were talking about earlier retail sales, CPI, Jackson Hole next week. So a lot of things that could move markets over the next few days. But when we look at the fundamental underpinnings of the U.S. economy, they remain quite solid in our view.
To me, the market pattern last week suggested some were still unconvinced that things had settled down. If you just look at those comments from Brian Moynihan, who was a very interesting commentator from my perspective, having spoken to him early on before others were saying higher for longer on rates. He called it early on. He was looking at a lot of inflationary signals. He was looking at his own base of numbers over at Bank of America. Now he is saying the Fed should cut rates soon. That's interesting signaling. Do you think the Fed needs to move swiftly? And if so, by how much?
So our base case is that the Fed is going to cut rates 3 times this year by 25 basis points each time, although we fully acknowledge the risk that they might cut 50 basis points at the next meeting. They have told us they're going to be watching the data, so that's what we need to pay attention to. So we will have another jobs report before the FOMC meets again on September 18th. So that will be key to determine how fast they move.
Yeah, I was wondering about that because it's very interesting that before we got the jobless data that moved the needle on this market picture by the seams of things, we got the Fed actually saying we're now going to be looking at this job market because that's the key penny to drop here. How important then is the next time that the Fed gets to speak, which is ultimately Jackson Hole, for rhetoric to say, well, we've fought the fight against inflation. We now feel that the jobs market is maybe too weak because it doesn't move in a straight line, but it does feel like it's going to get worse from here for that jobs market.
So it's interesting because the Fed have highlighted that they are going to look at their dual mandate, right? So full employment and inflation at the target. And they do see the risks to their dual mandate as balanced now. So I think when it comes to the labor market, a lot of the concerns have been around the SAM rule triggering because that has been driven by an increase in the unemployment rate. And of course, the SAM rule has typically triggered 2 to 3 months into a recession. So it's basically telling us that the U.S. economy is already in recession today. However, we would know 2 important things. First, the increase in the unemployment rate has not been driven by a deterioration in labor demand, but rather by an increase in labor supply driven by strong immigration into the U.S. So that's an important distinction. And second, when we look at a broader range of economic and labor market indicators, they're all still growing. So they're pointing to an economy that is clearly slowing down from a pace of growth that was definitely unsustainable, especially in the second half of last year, but an economy that is still growing nonetheless. That said, we don't want to completely dismiss the signal from the SAM rule or the inverted yield curves for that matter, which is why we assign 30% odds to a U.S. recession over the next 12 months. Not our base case, but higher than average odds.